trade that costs you the most is rarely the one with the largest loss. It is the one you take after you already know you should be still. You feel the market moving without you. You feel the pressure to prove that you saw it, and in that small moment, discipline becomes negotiable. That is where the damage begins. Not on the chart, but in the quiet permission you give yourself to break your own rules. A market does not need to defeat you with force. It only needs to invite you into one careless decision at the wrong time. One early entry, one widened stop, one revenge trade after a clean loss, one position added because you want to be right more than you want to be aligned. These choices look small in isolation, but they train the mind. Repeat them long enough, and you no longer have a trading system. You have a habit of bargaining with uncertainty. The serious trader eventually learns that the market is not impressed by intelligence, effort, or conviction. It responds to imbalance, timing, supply, demand, and the behavior of crowds under pressure. Your opinion may be detailed, but price is simpler. It either confirms your timing or it does not, and when it does not, the disciplined trader accepts that information quickly, while the undisciplined trader begins to explain, defend, and negotiate. This is why lasting success is not built on one remarkable call or one strong week. It is built on what you are willing to repeat when nothing feels certain. Every week, the market gives you opportunities, temptations, and traps that look almost identical at first glance. The difference is not always in the setup. The difference is in the trader observing it. Are you seeing the trade clearly, or are you seeing what you need it to become? You must learn to notice the condition of your own mind before you judge the condition of the market. If you are anxious to recover, you will find signals that are not there. If you are eager to participate, you will call noise a breakout. If you are afraid of missing the move, you will enter where patient money is already preparing to sell into you. Cause and effect are always present. Emotional urgency creates poor location. Poor location creates pressure. Pressure creates rule breaking. Rule breaking creates the kind of loss that teaches nothing unless you are honest enough to study it. The discipline code begins with a simple recognition. Your job is not to trade every movement, but to preserve your judgment until the right movement appears. That means watching how price behaves near obvious levels, how volume responds when traders are trapped, how quickly a move fails after drawing in late buyers, and how your own body reacts when the candle moves without you. These details matter because they reveal whether you are acting from preparation or impulse. There will be weeks when the best trade is the one you do not take. There will be sessions when sitting still feels like failure because the screen is active and your account is not. But restraint is not inactivity. Restraint is capital waiting under command. And until a trader understands the difference, every strategy becomes vulnerable to the same old weakness. So before we speak about entries, exits, risk, patience, and the weekly rhythm of disciplined speculation, we have to begin with the question most traders avoid when the market applies pressure. What part of your plan is the first to disappear? The first warning sign is not always a bad trade. Sometimes it is the feeling that you must do something before the market leaves you behind. The chart may be moving normally, but inside you there is a tightening, a demand for action, a quiet argument that says this moment is different. That feeling is dangerous because it arrives before the mistake, and because it usually sounds reasonable while it is forming. Pressure does not announce itself as pressure. It often comes dressed as confidence, urgency, intelligence, or conviction. You may tell yourself you are reading the tape better, that you are finally seeing the turn, that hesitation has cost you too much in the past. But underneath those explanations, the mind may be trying to escape discomfort. The trader who cannot sit with discomfort will often create a reason to act, and once a reason is created, the eye begins to search for proof. This is the first discipline. Notice when your mind begins to negotiate with what is plainly in front of you. A calm trader can watch price move without needing to own it. A pressured trader cannot. He sees every push as a missed opportunity, every pause as permission, every candle as a message directed personally at him. The market has not changed. His condition has changed. And once his condition changes, His interpretation changes with it. That is why pressure is more dangerous than fear alone. Fear may keep you from entering. Pressure makes you enter for the wrong reason, and then defend the decision because you do not want to admit why you took it. Once you act from inner pressure, the trade becomes tied to relief. You are no longer simply testing an idea in the market. You are trying to remove a feeling from yourself. That is a poor foundation for judgment. You should understand this clearly. The market will always offer movement. It will always provide enough motion to tempt the impatient mind. There will be sudden rallies, sharp breaks, fast recoveries, and quiet drifts that later look obvious. If your discipline depends on the market being clean and easy to read, it will not last. The market is not required to protect you from your own urgency. It will simply reveal it. So the work begins before the hand reaches for the order. Ask yourself what has changed in you. Are you calm enough to let the trade pass? Are you watching the market or watching your account? Are you reading price or trying to recover your confidence? These are not soft questions. They are practical questions, because every poor action begins as a poor internal condition that went unexamined. A trader must learn the difference between alertness and agitation. Alertness is quiet. It observes, waits, and recognizes when the conditions are developing. Agitation is noisy. It rushes, predicts, explains, and demands that the market provide relief. If you cannot tell the difference between the two, you will mistake emotional movement for market insight. And when that happens, even a simple chart can become a trap of your own making. Begin by watching the moments when your perception changes fastest. After a loss, after a missed move, after a winning streak, after a long period of waiting, these are times when the mind becomes vulnerable to suggestion. You may not feel reckless. You may feel focused, but focus without calmness can become fixation. And fixation narrows your view until you see only the evidence that supports the action you already want to take. The disciplined trader does not try to become emotionless. That is not the aim. The aim is to stop emotion from becoming interpretation. Feel the pressure, but do not let it write the story of the chart. Notice the urge, name it plainly, and give the market room to prove itself without your impatience standing in the way. This single pause does not guarantee a good trade, but it prevents many false ones from ever reaching your account. And once you can see pressure before it speaks for you, the next test becomes sharper, whether your actions in the market are as disciplined as your observations before the trade. A trader can be right in direction and still trade badly. That is one of the quiet frustrations of the market. You read the move well, you understand the level, you know where the risk should be, and still the result comes back weaker than it should. Not because the idea was poor, but because the execution was loose. This is where many traders deceive themselves. They judge the trade by whether the market eventually moved in the expected direction. But the market does not pay for being nearly correct. It pays for being positioned correctly, with the right size at the right place under the right risk. A late entry changes the trade. A careless fill changes the trade. A stop moved by a small amount changes the trade. These details may look minor, but they alter the entire equation. Execution is the place where discipline stops being an attitude and becomes behavior. Before the order is placed, discipline is only an intention. After the order is placed, it can be measured. Did you enter where your plan required, or where excitement finally pushed you in? Did you accept the defined risk, or did you adjust it because the trade looked promising? Did you leave the trade alone long enough for the setup to work, or did you interfere before the market had given a real answer? Small deviations create large consequences because trading is built on narrow margins. A strategy may have an edge only when its conditions are followed closely. Enter a little too late, and the reward shrinks while the risk remains. Give the trade a little too much room, and one loss begins to outweigh several proper wins. Exit too soon without a market reason, and the winners lose the strength they were meant to provide. The trader then looks at the system and says it is unreliable, when the real problem is that the system was never truly executed. This is the cost of being almost disciplined. It allows a trader to feel structured while still trading inconsistently. The rules exist, but they bend under contact with the market. One day the stop is firm. The next day it is flexible. One day the target matters. The next day a small profit feels acceptable. One day a setup must meet the full standard. The next day a partial signal is treated as enough. Nothing appears broken at first. But over a series of trades, the results no longer represent the plan. You must be careful here, because the market will sometimes reward poor execution. That reward is dangerous. A late entry may still win. A widened stop may save the trade. An impulsive exit may avoid a reversal. But when a bad process receives a good outcome, the lesson is corrupted. The trader learns to trust exceptions. Then, when the same exception fails later, he calls it bad luck instead of recognizing it as bad execution, finally collecting its price. The disciplined executor does not ask only, "Was I right?" He asks, "Did I trade it as designed?" That question separates outcome from conduct. A clean loss taken according to plan may protect the trader's future. A sloppy win may weaken it. This is not moral thinking. It is practical. The market allows randomness in the short run, so the trader must use execution quality as the standard he can control. Start by noticing the exact points where your plan becomes vague in action. The entry must have a defined condition. The stop must have a defined location. The exit must have a defined reason. The size must be placed before the trade begins, not negotiated after price starts moving. When any of these are left open, the trade becomes a series of fresh decisions made under changing conditions. That is no longer execution. That is improvisation. Precision does not mean perfection. No trader receives perfect fills, perfect timing, or perfect information. Precision means you do not casually change the nature of the trade after the risk has been accepted. You either take the trade according to the plan, or you let it pass. You either honor the invalidation point, or you admit the plan had no authority. Every order is a test of whether your rules are operational or merely decorative. And once execution becomes clean enough to measure, the next question becomes unavoidable: whether the numbers behind your discipline can survive the ordinary sequence of wins, losses, and drawdowns that every trader must face. A trader can survive being wrong many times, but he cannot survive being wrong too large. This is the arithmetic the market enforces without emotion. You may have a good eye, strong patience, and a sound method, but if the size of your losses is allowed to outrun the structure of your capital, the account begins to obey mathematics instead of intention. The first duty of risk is not to make you money. It is to keep you in the game long enough for your edge to express itself. An edge does not appear smoothly trade by trade. It arrives unevenly, through streaks, pauses, ordinary losses, and sudden improvement. If your risk is too heavy, a normal losing sequence can feel like a disaster, and a disaster can end the trader before the method has enough time to prove itself. This is why discipline must begin with numbers. Not because trading is only numbers, but because numbers define the boundary of survival. A 10% loss requires more than 10% to recover. A 20% drawdown demands a much larger return. The deeper the hole, the less freedom the trader has. Pressure increases, judgment tightens, and capital that should be used for opportunity is now being used for repair. Losses do not come one at a time in a polite order. They cluster. Even a sound approach can produce several losses close together. This is not a sign that the market has become personal. It is the normal distribution of uncertainty. But if you risk too much on each attempt, a common sequence becomes a serious wound. The trader then begins to reduce size when opportunity improves, or increase size when restraint is needed. The mathematics has already started shaping behavior. You must understand expectancy in plain terms. A trading method is not judged by one win, one loss, or one impressive week. It is judged by the relationship between average gain, average loss, and the rate at which each appears. A trader can win often and still lose money if the losses are too large. A trader can lose often and still advance if the wins are large enough and the losses remain controlled. The question is not, how often am I right? The sharper question is, what happens to my account when I am wrong? This changes the meaning of confidence. Confidence without controlled risk is only exposure with a pleasant feeling attached to it. Real confidence is the ability to take the next trade without needing it to rescue the last one. That is only possible when no single position carries enough weight to damage your judgment or your capital beyond repair. When the loss is planned within tolerable limits, the trader can think. When the loss is too large, the trader starts negotiating with survival. Risk of ruin is not a dramatic idea. It is simply the point where a trader's sizing, loss frequency, and drawdown combine to make recovery unlikely. It often arrives quietly, not from one reckless moment, but from repeated decisions that were slightly too large for the account. The market does not need to destroy the trader directly. It only needs the trader to underestimate how quickly small mathematical disadvantages compound. So before you admire a setup, calculate the damage if it fails. Before you increase size, ask whether your method has earned that increase over a meaningful sample, not over a recent feeling. Before you accept a larger loss, understand how many proper wins it will take to repair it. These calculations are not meant to make you timid. They are meant to keep you honest. The disciplined trader respects the fact that capital is not just money. It is time, opportunity, emotional room, and the ability to continue making clear decisions. When capital shrinks too far, every decision becomes heavier. When risk is controlled, the trader can treat losses as business costs rather than personal emergencies. The arithmetic of survival must come before the desire for gain. Once that boundary is understood, the trader is ready to examine another force that does not care about opinion, the behavior of price itself, and the way markets draw in those who mistake movement for truth. A market often looks clearest at the very moment it becomes most dangerous. Price breaks a level everyone has been watching, volume rises, the move seems confirmed, and the late trader feels the decision has finally been made for him. But the market has a habit of becoming obvious only after the easy money has already acted. What looks like certainty may be the invitation offered to the last buyers or the last sellers before the turn. Price does not move only because traders agree. It moves because traders are forced to act. A rally can continue because buyers are strong, but it can also rise because short sellers are trapped and must cover. A break can signal weakness, but it can also be the move that pulls in fresh sellers just before stronger hands absorb the supply. The disciplined observer does not ask only, "Where is price going?" He asks, "Who is being pressured here, and what will they have to do next?" This is where market behavior becomes a lesson in human positioning. Around obvious highs, lows, trend lines, and round numbers, many traders place the same hopes and the same protection. Their stops gather in similar places. Their entries gather in similar places. Their confidence gathers in similar places. When price reaches those areas, the market is not simply touching a line on a chart. It is entering a zone where decisions are concentrated. A clean breakout with acceptance is one thing. A breakout that quickly fails is another. The difference matters. When price pushes above a level and holds, it shows that buyers are willing to support the new ground. But when price pushes above, attracts attention, and then falls back quickly, the message changes. The late buyers are now trapped. Their confidence becomes risk. As they exit, their selling adds fuel to the move against them. The failed move becomes information. The same is true on the downside. A sharp break below support may frighten weak holders and attract aggressive sellers. But if price cannot remain below that level, the break begins to lose authority. Sellers who entered late now face a problem. They expected continuation, but the market refuses to confirm it. As they buy back, and as stronger buyers step in, the failed breakdown can become the start of a reversal. The market has not lied. It has tested commitment. You must train yourself to respect the difference between movement and acceptance. Movement is only the first message. Acceptance is the second. A candle can travel far and still mean little if price rejects the area quickly. A level can break and still fail if follow-through does not appear. A move that looks strong but cannot attract continued participation is often not strength at all. It is exhaustion wearing the clothes of strength. Volume and speed can help, but they must be interpreted carefully. Heavy activity near a level does not automatically mean continuation. It may mean transfer. It may mean panic. It may mean the final emotional rush of traders who are late to the move. Fast price movement excites the crowd, but speed without control can reveal urgency rather than quality. A disciplined trader watches what happens after the burst. Does price hold its gain? Does it reject the level? Does the market invite more participation, or punish those who arrived last? This is why chasing obvious movement is so costly. By the time a move feels safe, the risk may have shifted. The trader who enters only after certainty appears is often buying from someone who planned the trade earlier or selling to someone who waited for panic. The market rewards location, not comfort. If your entry depends on everyone else confirming what you want to see, you may be arriving where the crowd is most vulnerable. Begin to study the behavior around important areas instead of treating those areas as automatic signals. Notice how price approaches the level. Notice whether the move is steady or desperate. Notice whether rejection is immediate or delayed. Notice whether traders who entered on the break are quickly rewarded or quickly trapped. These observations teach you whether the market is accepting new value or only harvesting emotion. The discipline here is restraint through understanding. You are not waiting because you are uncertain. You are waiting because the market has not yet revealed who is trapped, who is in control, and whether the move has real support beneath it. Once you see price as pressure acting on groups of traders, the next step is learning how to decide which conditions are strong enough to deserve your own risk. Discipline rarely appears for the first time in the middle of a fast market. By then, the trader is already under pressure, the price is moving, and every weakness in preparation becomes more expensive. The market session does not create disorder in a trader. It exposes the disorder that was allowed to enter before the session began. A professional habit is not a ritual for appearance. It is a barrier against randomness. When you come to the screen without a prepared list, without important levels marked, without knowing which conditions matter and which do not, the market will assign your work for you. You will react to whatever moves first. You will give attention to noise because nothing has been ranked in advance. A scattered preparation leads to scattered action. The disciplined trader begins before the opening bell by narrowing the field. He does not try to watch everything with equal interest. He studies where price is likely to matter, where previous decisions were made, where volume may return, and where the crowd may become active. This preparation does not predict the future. It simply separates meaningful territory from empty motion. When price later reaches those areas, he is not surprised. He is ready to observe. This is the quiet power of planning scenarios. You do not need to know what the market will do. You need to know what you will do if certain conditions appear. If price holds above an important area, what does that suggest? If it rejects that same area, what changes? If nothing clean develops, are you prepared to do nothing? These questions, answered before the market becomes emotional, protect the trader from inventing answers under stress. A weekly routine gives the trader a wider frame. The market does not begin fresh every morning simply because the screen opens again. Each week carries unfinished movement, unresolved levels, strength in one area, weakness in another, and themes that may continue or fail. When you review the broader condition of the market at the start of the week, you avoid treating every intraday movement as equal. You understand which trades belong to the larger rhythm and which are only temporary disturbance. Daily preparation sharpens that rhythm into practical focus. Before the session, the trader should know what is worth attention, what must be ignored, and where risk should remain off the table. This is not about filling a notebook with opinions. It is about reducing unnecessary decisions. The fewer unnecessary decisions you make during live trading, the more energy remains for the few that matter. There is also discipline in ending the day properly. A trader who closes the screen and carries no record forward is likely to repeat the same confusion tomorrow. Notes do not need to be long, but they must be honest. What was planned? What actually happened? Where did the market behave cleanly? Where was attention wasted? The purpose is not to judge the day emotionally. The purpose is to improve the next day's preparation. These habits work because they reduce friction. A trader without routine must rebuild his structure every morning. He must decide what to watch, how to think, what matters, and when to stop. That drains judgment before the real test arrives. A trader with routine preserves judgment by making certain decisions automatic before capital is involved. Structure does not remove uncertainty from the market, but it removes unnecessary uncertainty from the trader. You should be careful not to confuse activity with preparation. Scrolling through charts is not preparation. Reading every opinion is not preparation. Drawing levels you do not respect is not preparation. True preparation gives you fewer things to do, not more. It should make the session simpler, cleaner, and harder to misuse. The professional trader builds a process that can be repeated on ordinary weeks, not only on inspired ones. He knows that discipline cannot depend on mood. Some mornings will feel clear, others dull. Some weeks will begin with confidence, others with caution. The routine must stand above those fluctuations. It gives the trader a known way to return to order. And once that order is built before the trade, the next test comes after the position is open, when the market begins to move and the trader must decide whether to interfere, hold, reduce, or step aside. The entry is not the finish line. It is the point where the market begins testing the quality of your judgment. Before the trade, everything can look orderly. The level is marked, the risk is defined, the reason is clear, but once price begins to move, the trade becomes alive, and a trader must decide whether the original idea is being confirmed, weakened, or simply passing through normal motion. This is where many trades are mishandled, not because the entry was wrong, but because the trader treats every movement after entry as a verdict. A small pullback feels like danger. A quick profit feels like something that must be protected at once. A slow pause feels like failure. Yet markets do not move in straight lines to satisfy the trader's comfort. A sound position can breathe, hesitate, test, and still remain valid. The first principle of trade management is to know the difference between fluctuation and information. Fluctuation is ordinary movement within the expected character of the trade. Information is a change that affects the reason for being in the trade. If you entered because price accepted a level, then rejection of that level matters. If you entered because sellers were failing, then renewed selling pressure matters. But a minor pause, a normal retracement, or a temporary shake may not matter at all. The trader who cannot separate the two will keep disturbing his own positions. A trade should be managed by evidence, not by comfort. Comfort wants the trade to feel safe at every moment. Evidence asks whether the market is still behaving in a way that supports the idea. These are very different standards. If you manage for comfort, you will cut strength too early and give weakness too much patience. If you manage for evidence, you may still take losses, but your actions will be tied to what the market is showing, not to what your nerves are demanding. This is why the invalidation point must have authority. It is not merely a stop on the screen. It is the place where the trade idea no longer deserves capital. If price reaches that point, the market has answered. You do not need to argue with it. But if price has not invalidated the idea, then constant interference becomes its own form of risk. Moving too soon, adjusting without reason, and reducing simply because the trade is uncomfortable can turn a good position into a weak result. There are also times when a trade earns more room. Not because you hope it will work, but because the market has improved the position. Perhaps price has moved away from the entry with strength, accepted a higher area, or forced the opposing side to retreat. In that case, managing the trade may mean protecting part of the gain while still allowing the larger idea to continue. The point is not to predict perfectly. The point is to let new evidence change the management without changing the discipline. Partial exits require the same seriousness. Taking something off can reduce pressure and secure progress, but it can also become a habit of cutting winners before they have done their work. Ask yourself what the partial exit is responding to. Is the market showing a real obstacle, exhaustion, or rejection? Or are you simply relieved to see profit and afraid to let the trade develop? The action may look the same, but the cause behind it changes the quality of the decision. Adding to a position carries even greater responsibility. A trader should not add because the trade feels good. He should add only when the market has reduced uncertainty in a meaningful way and the new risk can be justified on its own. Each addition must be treated as a fresh decision, not as a reward for being right. When adding is careless, one good entry can become an oversized problem. When adding is disciplined, it is built on confirmation, not excitement. You must also know when the reason for the trade has changed. A position may still be profitable while the original thesis has weakened. Price may continue drifting, but the force behind the trade may no longer be present. This is a subtle moment. The undisciplined trader waits for pain before admitting change. The disciplined trader studies behavior before pain is necessary. He understands that a trade can lose quality before it loses money. So while the position is open, keep returning to one practical question: what is the market proving now? Not what did you believe at entry? Not what profit do you want? Not what loss do you fear? What is being proven now? That question keeps management attached to present evidence. And when a trader fails to ask it, the same quiet errors begin to appear again and again, which leads directly into the habits that can make even capable traders reckless. Recklessness does not always begin with a wild trade.